Welcome. My name is Asher Rogovy, and I'll be your host today. Today we have Brandon Pacilio from Alpine Hill Advisors. Brandon, welcome.
Thank you for having me, Asher. I'm very excited to be on the call today.
Great. Well, as always, let's get started with everyone's favorite, the NAAIM Exposure Index. Let me pull that up here. This is an index. It's a survey from all of our members to find their aggregate equity exposure. This week it's 87.94, down from 93.84 the previous week. Still very high. Still a lot of exposure to the equity markets. People haven't scaled back their positions just yet. Brandon, what's your read on this? What have you seen in the markets lately?
I think, and we've talked about this in the past, Asher, is currently we're seeing this flight to quality trade across markets where people are now focused more on value. You've seen some sectors like ITB, the home builders ETF have done really well. And there's been such a great run up in tech that it's time for people to focus more on value and look at the fundamentals. And I think you're really starting to see that rotation in equity markets. And you've even seen it in the bond markets as well, where the 10-year treasury is coming down. It's hovering right around 420. It was as high as 440 a month ago. So people are kind of risk off a little bit. That's kind of what my sentiment is in the market currently.
Okay, but no reason to really pull back in anticipation of a crash or bear market.
No, I think it's just looking across the equity markets and understanding what's performed really well, where can you take some profits, take some chips off the table, and rotate into sectors that I think have now room to run. And that value trade, I think, is here to stay.
Okay, great. Well, anyone listening, if you're interested in learning more about this exposure index, you can come and mingle with the rest of the members at the NAAIM Outlook conference this fall, October 28th and 29th in Dallas, Texas. Tickets are available now at NAAIM.org, and members have an early bird discount until August 2nd. So hope to see you all there. All right, Brandon. So you're a new member to NAAIM. First of all, welcome to the organization, and thanks for joining. Maybe you can you give us an introduction about yourself and your firm and your style?
Yeah, no, absolutely, and thank you. I'm very excited to be speaking with you today, Asher. I want to thank you personally for bringing me into this organization. I think it's a great organization, and active investment management is something that I love, right? And specifically in the fixed income markets too. So my background is I worked at a fixed income broker dealer, Sumridge Partners, for 4 years, creating corporate bonds and municipal bonds, and got great experience there. Spent a year at Bridgewater Associates at a client service. And then I've been on the RIA side ever since. And now I run my own registered investment advisor in Westport, Connecticut, called Alpine Hill Advisors. So when we think about our liquid investment strategy, we buy individual stocks when we see fit, ETFs, but then at the core of what we do is focused on fixed income, looking at corporate and municipal bonds. And we build and curate unique bond portfolios for our clients depending on exactly what their particular needs might be.
Fantastic. Most of our members are more focused on the equity side. So we're all eager to learn about how active investing works with bonds. Like what kind of strategies are available? What do you look for in individual bonds? So please tell us.
Oh, thank you. So it's funny, right? With the equity component, it's a extremely liquid market. Everyone had this conception that bonds, over-the-counter product, it's a little bit esoteric. Maybe there's not as much liquidity, but in actuality, in today's bond markets are pretty efficient. I say pretty efficient because they're not perfectly efficient, and that's when you can provide alpha for your clients, right? So corporate bonds across the board, you have different ECNs, meaning market makers, where you're able to source liquidity for your bonds. If you go on to the different custodians, you could see their bond offerings. You have relationships with bond dealers. So there's really a robust market for firms like ours to find and execute bond strategies for different clients. So the way we think about fixed income, there's really two main components, right? So for some of our clients, we use fixed income to give them a synthetic paycheck when they're maybe reaching entire retirement or in retirement. And that's unique with bonds because we're able to build out customized laddered portfolios. So we know exactly when bonds are maturing, when the coupon payments are coming due, and we can give our clients that income projection, which is unique compared to buying a bond fund, where you're buying a bond fund, but it's really not, it doesn't have the same characteristics as what a bond is, right? Bonds have permanence and definition, meaning that you know clearly when the money's coming, versus a bond fund is, yes, you get that monthly income stream for it, but if there's a forced selling like we saw in March 2020, your bond, the value of that fund is going to drop precipitously, and you might not recoup that value. Where when you own the individual bond, you might have paper losses, but you still know at maturity you're going to get your money. So that's one component, right? So it's the fixed income stream, synthetic paycheck, bond ladders for retirement. But then also we look at bonds from a total return perspective too, right? Because we believe in the bond markets, there's really good opportunities for risk adjusted returns, right? So if you do your homework and you understand the credit, meaning the individual corporation or municipality, you're making that bet of, is this going to pay me back? And if it does, you could take advantage of that. So that's the second component of bonds, and that's where maybe someone who's not reaching retirement but sees really good value in the total return play from bonds, because from a risk adjusted basis, it's a little bit higher than equities, but you can get similar type returns, specifically in the high yield markets, meaning double B or below from a credit rating. We also like to take advantage of that space as well.
So you're looking not only to time an income stream, achieve certain client objectives, but also looking to outperform these funds, certainly on an after fee basis, I'd imagine. But just even before fees, if you can pick better bonds that have improving credit, or I don't even know. So what do you look for? Like what kinds of trades can you find using individual bonds as opposed to investing in a fund?
Right. I think it's a good question, because the funds, they're going to be benchmarking to a specific index. And in the funds, because they're benchmarking to a specific index, they're going to have to buy a lot of stuff that necessarily we don't want in a client's portfolio. We could manage the portfolio to a specific yield bogey that we talk about with our clients, right? So if someone wants 5 or 6%, we can go and get them 5 and 6%. And when you mention a specific trade, the benefit now of higher interest rates are that you're able to take less risk on the credit rating perspective to get that 5-6% return than you did just a few years ago, right? A few years ago, we were buying single B or double rated corporate bonds and only yielding 3.5-4%. Well, today we're buying triple B rated bonds at 6.5%. And that's really been a great thing for our clients. So for us, when we see higher interest rates, it's a great time to be buying bonds. And so to answer your direct question as well, one of the key characteristics that we look at is it's going to be the corporate credit rating, it's the coupon rate, the yield, and also we can get very specific too from an industry perspective, right? So say if someone only wants to buy tech-based bonds, or they want to look at energy bonds because maybe they see an opportunity there, we can get super specific. And what we haven't even talked about yet is looking at it from a tax perspective, that I'd love to continue the conversation with you on that.
Absolutely. I know there's a lot of there's some tax-free municipal bond funds for popular areas like Manhattan or California or something like that. But I'm sure that you can work wonders for clients in other areas for which there's no dedicated bond fund.
Well, that's exactly right too. So when you look at these larger fixed income managers, right, they have to be able to manage to a massive amount of people and have that scale for their institutional investors, right? So they might look at certain states and not buy those certain states because there might not be enough issuance out there to have that scalability for their portfolios. Where for us, say you're a North Carolina resident, we can curate that North Carolina portfolio for you over time, rather than some of the other larger fixed income managers might say, look, we can't offer you a North Carolina portfolio because they won't be able to produce that portfolio in large quantities. So we'll look specifically in the secondary market, where most people will just look at the primary market. So if the primary market, if there's not enough issuance there, they might say, I'm sorry, I can't buy North Carolina bonds for you. And what's important to note too is that instead of getting in either a municipal bond or a corporate bond strategy, we're able to say, look, in your portfolio, let's look at things on an after-tax basis. So when we're looking at bonds weekly, daily, we're doing that calculation to see what the after-tax return is. So sometimes it may be more advantageous to buy a single A-rated municipal bond that's yielding 3.5%, because on the pre-tax basis, that's equivalent to a 6.5% rated corporate bond if you're in the top tax bracket. So we can be very specific and cater the portfolio specific to our clients' needs from a tax basis without having to say, no, you need to go into a corporate bond or you have to go into municipal bond fund. And I think that's one of the unique advantages that we have. Not to mention too, just to continue on that point, is where if you're in a bond fund, right, that might just be one position you might have to manage. Where for us, we're able to consistently do bond swaps, right? So we could bank taxable losses and then just go rotate into a new bond that has the same par value, and the par value is where your coupon payment's being based off of, so that the income stream doesn't change, but all you did was now bank a capital loss. And I think that's one of the things that we've been doing in the past couple of years when you've had this blowout in interest rates and maybe you have some paper losses in your portfolio. We've actually been able to say, no, let's bank that loss and then rotate into a new bond with the same par value and capture a higher income stream and a higher yield. And that's been something that our clients have loved.
Tax loss harvesting, fantastic.
Correct.
I never even thought about that in the bond market, but of course, why not? So that's great. With the portfolio of individual bonds, you have more adjustments to make than just a few funds, right?
Yes, absolutely. And I think with the bond markets, that's why when we started off the call, I said it's pretty efficient, right? So everything prices off the treasury curve, and risk adjusted off of that, right? The quote unquote credit spread. But that being said, so it is efficient in a market from that front, where a double B rated bond is going to have a wider credit spread relative to a triple B rated bond. But then if you really get in and do your homework, you can find different discrepancies to provide that incremental return for your clients. And it just takes time, and it takes the diligence to do that. And then that's where you start to get the outperformance on the individual bond level that you might not get from a bond fund, because they don't have that flexibility to be able to do that as frequently, right? Because they're going to be swapping out of bonds sometimes too, depending on cash coming in or cash coming out of the fund, right? So if you looked at March 2020, it was a fantastic time to be buying bonds if you had cash on the sidelines. As rates blew out, as credit markets froze, right? Everything was completely mispriced. But what happened was people were getting out of bond funds, so they had to be forced sellers, where for them at that time, they should have been buyers of bonds. But for us, we were able to take some exposure off the equity table and rotate into bonds, and just to capture that additional yield that was once in a lifetime opportunity for some bond investors.
Fantastic. So it's not just about security selection; you're also timing the yield curve.
Yes, it's security selection. It's the yield curve. There's numerous factors that go into it, and then sometimes too, with even just looking at an individual corporation, right? So we use the example of a company like Ford. They have billions of bonds outstanding, and you can find individual discrepancies in that capital structure too to get incremental yield. And there's a choice for everyone in the bond markets, right? So if you want to be super conservative, you could just buy single A rated bonds. If you want to, take on that additional risk and get compensated for that, you can go into the high yield market. So there's so many different factors that go into it. And it's really goes back to the client, right? So when you go into a bond fund, the portfolio manager at that bond fund is never going to know that client. They're not going to know, oh, maybe just right off the bat, they won't like this company if we buy it. Where for us, we're able to get exactly what the client needs. for example, we have clients who just say, I want the income. So just buy me right now high coupon bonds. Maybe I'll give up some of that purchasing power because the higher coupon bonds might be a little bit more expensive, but they just want to know that each month or quarter, they're getting a higher income stream from those coupons. Where going back to our conversation a little bit earlier, where some clients just say, hey, give me total return. So maybe I'll buy low coupon bonds that might be a little bit more juice if rates start to really come down, right? So it's knowing the client, it's being able to customize things. And I think that's one of the unique benefits of owning individual bonds.
Very cool. So, so what's your outlook for today? Do you have any favorite maturities or sectors or credit ratings that you're finding value?
Yes. So if you don't mind, I would like to share a chart with you, just to give a snapshot of what the current interest rate curve looks like. Asher, can you see that?
Yeah.
So this green line gives you an indication of where we are with interest rates today. So as everyone's aware, it's an inverted yield curve. So there's a higher rates are in the front end of the interest rate curve. So what you have to be careful with is just loading up on just short-term bonds, because one of the key principles in bond investing is the reinvestment risk, right? That means once that your bond matures, what is the interest rate environment going to look like? And so if you go into short-term bonds, and let's say the Federal Reserve, I'm not saying that's what they'll do, they lower rates back to zero. If your bond matures in 2 years, now you're going to be investing in an interest rate environment with low rates. So you won't be able to get that return. So where we like to do is we focus really on that 7 to 10 year range right here. Because we believe, look, you get good yield. Maybe you don't get that 5.35%, but you're locking in for 7 to 10 years for a 4.25 10-year treasuries. And then when you add that credit spread to it, that's probably 5.5, 6%. And we don't think it makes sense to really extend the duration or the maturity profile of the portfolio out to 20 or 30 years, because if you see from here to here to here, it's only 20, 30 basis points on the curve. So it doesn't make sense to go lock in a maturity range of 20 to 30 years, knowing that you're only getting 25 to 30 additional basis points. And that being said, too, the long end of the curve tends to be the most volatile part of the curve. And so with specifically too, so that's what we like about the curve, but we also will take advantage of the short-term aspect of things and just get that incremental yield.
Okay, fantastic. That is maybe that is counterintuitive that the long end is the most volatile.
Because the Federal Reserve can't control interest rates in the long end, right? Because there's all the different supply and demand, inflation expectations. There are a ton of variables that get factored into the long end of the interest rate curve, and that's where you're going to have that whipsaw. So generally speaking, if you think about the normal interest rate curve, it's upward sloping. So as you extend your maturity, an investor should be compensated for that additional risk because of all of those extraneous variables that go on the back end of the interest rate curve.
Okay. So yeah. Thanks. That's a great outlook. There doesn't seem to be much difference between, like I said, 7 and 20 years, and who knows what could happen 7 years from now. There's probably going to be some other opportunities to reinvest when there's a kind of a peak in the curve. Is that right?
Well, that's why it's good. So specifically where we like in the curve, this is 7 to 10 years, but you can't be naive to the fact that the front end of the interest rate curve is giving you that great yield right now. So that's why you take a barbelled approach where you're going to buy some 7 to 10 year bonds, knowing that you're locking in those yields for the next 7 to 10 years at 5.5 or 6%, and say, okay, look, I'm also going to take advantage of these short-term yields. And if they mature in a year from now and interest rates are higher, great. But if not, at least I know I have that. Now it'll be 6 to 9-year bonds still giving you that higher yield as that front end of the interest rate curve starts to drive down this way.
So you're giving yourself kind of multiple options with what to do, how to allocate that capital.
That's exactly right. You're giving yourself optionality and trying to mitigate some of that reinvestment risk. Because what happens if you are just all here, and let's say interest rates drop and all of this drops, now, okay, you had your entire portfolio mature next year, and now across the curve, the 10-year treasury rate's at 2%. So that means investment grade bonds might be at 3.5%, 4%, where that's fine, but it's better to take a more balanced approach, knowing that today there's great yield of getting 5.5%, 6% in investment grade bonds, especially when you think about what we have seen in the past few years when we're so yield starved in bond markets. And I think one caveat to note too is that everything you read right now is there's trillions of dollars in money market funds, which is fantastic, right? Because people say it's super safe, it's super short, we're getting great yield. Why would we do anything else? That's fair, but all of a sudden interest rates move quickly. And when they start to go down, they might go down pretty fast, and that velocity will be rapid. So you don't want to get left out in that trade of, oh, I'm just sitting in money market getting great yield, but then all of a sudden rates fall out below me, and now you can't buy the yields that you're getting today at 5.5%, 6%.
Right. Great. I've got a couple other just random questions for you. If I buy a 7 to 10-year bond ETF, it's constantly rolling over. Whereas if I buy the 7 to 10-year bonds, they will shorten in maturity. Does that constant rollover cause some problems for bond fund holders?
I just think in general with bond funds or ETFs, the whole purpose of buying bonds, at least from my perspective, is that you know what you're getting for the foreseeable future. To your point about the rollover and the changes in the ETFs, the bond funds, right? There's going to be a lot of vibrations and gyrations across the way. There will be when you look at your statement too for owning an individual bond, but at least you know it matures on this specific day. I'm getting a coupon payment twice a year. There's a lot more predictability, and especially if you have clients who are nearing retirement or in retirement, that predictability is the most important thing, right? Because they're gonna live their whole life off of that paycheck that you give them from their portfolio.
Okay. And another question I have is about tax. So we touched on tax-free municipals, which are the interest is exempt from
Federal tax.
Federal tax. Also state and local though, right?
Yes, if you are a resident of that particular state.
Right.
So if you're a New York resident and you buy New York municipal bonds, that'll be that triple tax exemption. There are a few additional exemptions too. If you bought Puerto Rico bonds, that was triple tax exempt, and there was issues there a few years ago where there was all this bond issuance of Puerto Rico paper, and they couldn't support those debts. But that's our distressed debt investing call that we'll have later.
Okay. What about offsetting? So if you have taxable income from interest, you can offset that if you have a mortgage, right?
That I would ask your CPA exactly how that would operate, because look, everyone's situation might be different. We view with the bond interest is going to be ordinary income. There are advantages where if you buy preferred securities, sometimes you get that qualified dividend income, which will then be at that 20% rate. So you don't want to avoid that segment of the market. It's a good market to look at. They call them hybrid securities or $25 per par value bonds. That's another market to consider, but that's going to have a little bit more price volatility. And also, too, technically, you're buying a preferred equity. So it's different than a bond where you have higher assets backing your bond.
Yeah, we can maybe do another call about preferreds, but I also understand that there's a lot of inconsistency with how the securities are
Classified.
structured, and there might be calls and um, different voting rights and things like that might affect valuation. Great. So why don't we finish up with do you have any quotes that you think are appropriate for investing? Any wisdom from great investors or other sources that um, uh, that can help us think how to invest better?
Yes. So being a student of bond markets, when you first learn about bond markets, everyone's talking about Howard Marks, right? Widely successful founder of Oak Tree Capital Management, and he would always come out with these memos. And in one of the memos I remember reading, he talks about yogiisms, right? And the Yogi Berra quotes. And one quote that really stuck out to me that I think is important in investing is it's Yogi Berra says, "Nobody goes to that restaurant anymore because it's too crowded," right? So it's this idea of when something's that popular, maybe it's too popular and that's not the right thing, right? We can all attest to that in investing, right? Where you want to find those opportunities. You don't want to follow the herd or follow the crowd, where you want to create your own path. So I think that quote is very important, particularly when we had the conversation about, money market funds and everyone's just getting that 5.5% yield in money markets, but that could quickly turn and the tide's going to go wash out to sea. And if you were just able to lock in some yield by buying longer dated bonds, you'd get that great yield and not have to worry about it, where those money market funds are now yielding 3% and you're looking around to find yield, but there's no more yield to be had.
So there's value in maintaining a contrarian outlook.
Always. I think that's always the case. You just have to be solvent for your trade to happen, right? And I think that's what happens with contrarian investing sometimes too, is that the thesis might play out. It just takes a little bit longer.
It's all about timing.
That is, and that's the beauty of this organization, right? It's about timing, doing the homework, and I think bringing you back to individual bond investing, there's timing into it, but I think it's super rewarding when you do the homework and you see everything come to fruition, and you're able to help your clients really achieve what they're looking for, as far as from an income perspective, from a risk perspective, and I think bonds really offer that.
Fantastic. Well, Brandon, thank you for sharing your wisdom with us today. I'm sure we'll love to chat more and learn more at different NAAIM events and webinars and meetings. I think there's a lot to the bond market that you can help us understand and we can all take advantage of. So in the meantime, where can we learn more about you? Do you have a website? Do you have a Twitter or anything?
Yes. So we have our website, Alpine Hill Advisors. If you Google us, and we'll put some market commentary out there. We're actually going to be putting out a piece pretty soon about the benefits of buying individual bonds. So it'll kind of piggyback this conversation that we have here. And we're based in Westport, Connecticut. We're always open for a conversation and to share philosophy, share ideas, because it's the markets are very fascinating. They're ever changing, and it's great to collaborate and talk markets.
Fantastic. Brandon, thanks again, and we hope to see you at the Outlook conference this fall. Tickets are available at NAAIM.org, and there's an early bird discount for members until August 2nd. All right, well, thanks again, and I'll see you next time.
Thank you, Asher. I really appreciate your time today, and thank you for inviting me on the podcast.
Of course. Thank you. Bye-bye.